Value investor Mohnish Pabrai just overhauled his U.S. investment portfolio and went heavy on one stock, trading around 3 times free cash flow. In this video, I'm going to walk you through the dramatic change in his portfolio, as well as focusing on that particular stock that he's been buying into, talking about the thesis on why he might see merit in this stock. If you enjoy educational investment videos, please make a point of hitting that thumbs up, hit that subscribe button. You're watching Unrivaled Investing. And so Mohnish Pabrai, you can track what's changed with his investment portfolio online. This is website Datarama. You can see Pabrai Investments, and you can see that he completely overhauled his U.S. holdings. Previously, a large investment in Micron and Brookfield Corporation, as well as Seritage Growth Properties. It's worth pointing out that this is just his U.S. holdings. You can't see his international portfolio. This is only U.S. holdings, and you can see he sold out of these positions, Micron, Brookfield, Seritage, and went heavy in Alpha Metallurgical Resources. Nearly 80% of his U.S. portfolio now in this one position. The other remaining is Consol Energy. In this video, I'm going to focus on Alpha Metallurgical Resources, or AMR, to understand what does he see in this stock. I mean, this is particularly surprising because a lot of investors have followed him and similarly purchased Brookfield. I actually called out Brookfield a while ago here on YouTube. Brookfield has a lot of separate different entities. I personally own the asset manager. However, a lot of folks were making the call that Brookfield Corporation, BN, trades at a huge discount to their portfolio value, particularly their real estate portfolio, which is worth tens of billions of dollars, saying, hey, the public value for Brookfield doesn't really give a lot of credit. And so there's a lot of investors saying Brookfield has tremendous upside, hundreds of percent upside. I talk more about that, both here online on YouTube, which you can see the previous video, as well as with my exclusive community at unrivaledinvesting.com. So a lot of people are surprised to say, wait a second, here's a value investor, with Brookfield, a long track record of tremendous returns, and he's selling out of that to buy, Alpha Metallurgical Resources. What is that? What is Alpha Metallurgical Resources? Well, Alpha is the largest and most diverse U.S. met coal producer, producing 16 million tons of coal in 2022 with 323 million tons of met reserves. So this is a company with years and years of reserve production ahead of it, based on what they have, producing this year versus what they actually have in reserves. And this is a company with producing around a quarter, a little under, of the total U.S. met coal in the U.S., and it's being shipped all around the world. For those that aren't familiar, met coal is primarily used for global steel production. And so this is heavily tied to met coal prices, are heavily tied to underlying global steel demand. One growth driver is projected to be India, which is, expected to see continued crude steel production growth in the decades ahead, as their country develops. And so, that could create some sort of buffer for met steel or met coal prices. So the question is, well, where does Alpha Metallurgical Resources go from here? Why does, Mohnish Pabrai see tremendous value in it? Well, first of all, in full disclosure, this is not financial advice. And I also, quick plug, I recently bought more of a stock that I think has over 300% upside potential that I called out to my subscribers at unrivaledinvesting.com. So if you're looking to take charge of your investment journey with compelling ideas, market insights, and an exclusive Discord community available for annual subscribers, come check it out. That's unrivaledinvesting.com. And so what's the value proposition here with Alpha? I think there's a couple of clear dynamics that Mohnish Pabrai sees with Alpha Metallurgical Resources, or AMR, versus that they've paid down their debt. So you're talking about an entity that's previously effectively gone through bankruptcy, gone through restructuring, and now you have, something with years and years of production ahead of it, years and years of proven reserves, met coal reserves used for global steel production, and you have something without really any debt. You might have some legacy liabilities tied to the workers, tied to cleaning up the coal, facilities afterwards. But broadly, you have a very clean balance sheet. So as long as you have this sort of runway, even if you don't know what's going to happen with coal prices, because you have this multi-year runway, let's say 2 decades ahead of you, and you don't really have tremendous senior claims, that means the free cash flow that's going to be generated over the next 2 decades, that can get returned to shareholders. And there's potentially a lot of free cash flow that can get to return to shareholders. And so this is a key aspect of no matter what's going on with the coal market, because you don't have debt that's sort of strangling the company, you're now in this position to fund that free cash flow straight to shareholders. Plus, because of the prior bankruptcies, this company used to be part of Contura, which itself came out of bankruptcy, I believe. And so here it is. This is a company with over $1 billion of tax assets. So that means they're going to be paying much less in taxes on their free cash flow in the years ahead. And I think a key aspect that he sees is looking at a company where this next year they've committed 71% of their met production is set at around $190. So this is contracted out at $190 per ton versus their cost per ton of only around $106 to $112. So it's very likely, just based on what they've committed, even if they haven't committed themselves for the full year, just based on what they've committed, they're still likely to generate lots of free cash flow based on the prices that they've set. And if you look at their year-to-date results, I mean, during the first half of the year, June 30th, 2023, you can see that they're making around $300 million in free cash flow. So around $700 million in free cash flow potentially for the year. I mean, that's how much they actually did in the first half of last year. So easily this company's doing $700 million in free cash flow, maybe potentially more, relative to a stock that only has around a $2.7 billion market cap. So you could say, wow, this company's trading maybe, 3 times, maybe 4 times free cash flow. There's no real senior sizable claims ahead of you. It's not like there's this huge debt facility that needs to get repaid. I mean, this is, classic story of when you have an industry where capital has been pulled out of it, then you can have these sort of dynamics where you can generate attractive returns over time, because people just say, ugh, I don't want to invest in a coal company, and you have restructurings and you have bankruptcies, and then people say, well, wait a second, there's not a whole lot of new capacity coming online, or there's you're able to generate really fat margins. And so you're seeing a situation where it's trading at 3 times free cash flow, $700 million in free cash flow this year, more than that last year. And folks are saying, well, maybe I just don't want to own it because of coal. And that's creating an opportunity for AMR shareholders, because you can see that they've reduced their share count by nearly 30% in just the past year and a half, from March 2022, from around 18.6 million shares to around 13.7 million shares in July. So that's a key compelling aspect to the thesis. And once again, when you look at their various different properties around West Virginia and in Virginia, you could see, various different productions, such as, the Midwest Virginia underground producing, nearly 2 million tons of met coal, but they have reserves for 124 million tons. So you're talking about long life assets. So no matter what happens with the economy in any given period, you're going to have something that's going to continue producing, even if it's, let's say, break even for a few years. Because it's a multi-year runway, you're likely to have that free cash flow return to shareholders. And I think this is a really important lesson for investors to consider, is that there's a lot of different ways for folks to do well on Wall Street. I personally like Mohnish Pabrai a lot. I think he's a very, thoughtful investor. And I think he's also a good person as well, based on, seeing his initiatives with Dakshina, which is about lifting up students in India with, that test really well and sometimes have disabilities. And so I really like, what he's doing. And, if you want to check out Dakshina, I highly, recommend it. I'll even leave a link below in this video. And so I hope this works out for Mohnish Pabrai, in his investment portfolio. It wouldn't surprise me if it does, just because it's one of those situations where even if it doesn't, let's say, tremendously improve, if the market just sort of stays flat, and you're buying back 30% of the company each year, well, that's could create just tremendous returns over time, because, over time, you retire 30%, then you retire another 30%. Before you know it, there's only a handful of shareholders that own an entity that's producing hundreds of millions of dollars in free cash flow. And then the stock price goes up really tremendously. And so it wouldn't surprise me, to see that possibility. It wouldn't surprise me to see tremendous returns for AMR in the future, based on this setup where you don't have this big debt in front of you. You're tied to a commodity market, but they're sort of hedging that out by saying, okay, well, we're committing 70% of our production so far in 2023 at these set prices, but they also have multi-year production, in terms of proven reserves. So even if you do have, let's say, a global recession, they're probably likely to be able to stomach it, maybe a few years of, break even or unprofitable, but then you get that multi-year production and then the free cash flow gets to start going back to you as a shareholder. And if the stock falls significantly because of fears of, let's say, a global recession, then you're still in a position where maybe they can buy back even more shares, which I think Mohnish Pabrai would probably like. Now, I think this is a really important lesson because not every investor has to follow this path. I personally don't think I'm going to be buying AMR. I personally like to buy things, maybe even if it's at a much higher valuation multiple. Maybe I'm buying something at 20 times free cash flow or buying something at 15 times free cash flow, but I just like the greater certainty of my thoughts on its growth trajectory over time. So every investor needs to figure out what's right for them. And this is a perfect example of, no two journeys are identical. You should figure out what, sort of fits your temperament. With something like this, a lot of folks might say, well, who knows what's going to happen to coal prices? And that's a bit outside the scope of this video. I'm not, I don't have a call on that, but I think the dynamic of this investment is that Mohnish Pabrai doesn't really have to have a prediction on what's going to happen to met coal prices either. He just needs to survive long enough, and without debt on the company, this tremendously low valuation multiple, you have this potential for tremendous buybacks, juicing your return over time. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.